A 1031 exchange allows investors to defer capital gains taxes when selling an investment property. Reinvest your profits into a similar property without immediately paying taxes. This strategy can grow your real estate portfolio over time. It's like a snowball effect for your investments. Sell an apartment building for a profit. Use a 1031 exchange to reinvest into another property. Deferring taxes gives you more capital for greater returns. Not all real estate transactions qualify for a 1031 exchange. To take advantage of this tax deferral strategy, you need to meet specific requirements. First and foremost, both the property you're selling, known as the relinquished property, and the property you're buying, known as the replacement property, must be held for investment or business purposes. For instance, you can't swap a rental property for a primary residence. The properties involved should also be considered like kind, meaning they are of the same nature or character, even if they aren't identical. For example, you could exchange an apartment building for undeveloped land or a shopping center for an office building, as long as both properties are held for investment or business purposes. You'll also need to work with a qualified intermediary, or QI. This is a crucial part of the process, as the QI plays a vital role in facilitating the exchange and ensuring everything complies with IRS regulations. Think of the QI as a neutral third party who holds the proceeds from your sale and uses them to purchase the replacement property on your behalf. Time is of the essence when it comes to 1031 exchanges. Strict deadlines must be met to qualify for the tax deferral. Once you sell your relinquished property, you have 45 days to identify potential replacement properties. This identification must be in writing and delivered to your qualified intermediary. You don't have to find just one property. You can identify up to 3 potential replacement properties, or even more under certain circumstances. The key is to act swiftly and strategically within this 45-day window. Once you've identified your replacement property or properties, you have another strict deadline looming: 180 days from the sale of your relinquished property to close on the purchase of the replacement property. This 180-day period includes the 45-day identification period, so it's crucial to factor in the time it takes to find a suitable replacement property, negotiate the purchase agreement, and complete all necessary due diligence. Section 4, utilizing properties in exchange funds. One of the most attractive aspects of 1031 exchanges is the flexibility it offers in terms of the properties involved. As long as the properties meet the like kind and held for investment or business purposes criteria, you have a wide range of options to choose from. You could sell a single-family rental property and use the proceeds to acquire a multi-family apartment building, increasing your cash flow potential. Alternatively, you could exchange a commercial property in a declining market for one in a more desirable location, potentially boosting your property's value and rental income. In addition to directly purchasing replacement properties, you can also utilize 1031 exchange funds, also known as qualified intermediary accounts. These funds allow you to park the proceeds from your sale with a qualified intermediary while you take your time identifying and acquiring a suitable replacement property. Section 5, weighing the benefits and pitfalls. Like any investment strategy, 1031 exchanges come with their own set of benefits and potential drawbacks. On the plus side, the ability to defer capital gains taxes is a significant advantage, allowing you to reinvest more of your profits and potentially amplify your returns over time. Moreover, the flexibility in choosing replacement properties provides investors with opportunities to diversify their portfolios, strategically reallocate assets, and potentially upgrade to more desirable or profitable holdings. However, it's essential to acknowledge the potential pitfalls as well. Meeting the strict timelines and deadlines can be challenging, especially in competitive real estate markets. Failing to adhere to these timelines could result in disqualifying the exchange, leaving you with a hefty tax bill. Additionally, while the concept of like-kind properties is relatively broad, there are still restrictions that could limit your options. There are material risks associated with investing in DST properties and real estate securities, including liquidity, tenant vacancies, general market conditions and competition, lack of operating history, interest rate risks, the risk of new supply coming to market and softening rental rates, general risks of owning, operating commercial and multifamily properties, short-term leases associated with multifamily properties, financing risks, potential adverse tax consequences, general economic risks, development risks, long hold periods, and potential loss of the entire investment principal. Because investor situations and objectives vary, this information is not intended to indicate suitability for any particular investor. For more information about 1031 exchanges, call or text us at 813-710-4123. Thank you and God bless.